Hi, welcome to Next Brief. I'm Rebecca Valiz. I'm a partner in Armanino's tax practice. Every day I work with privately held businesses to navigate tax challenges, uncover opportunities, and make strategic decisions that help them grow with confidence.
And my name is David Schellen, a tax partner in the privately held business practice. I have quite a number of professional service clients and quite a wide repertoire dealing with multi-state tax issues. So I'm very happy to be joining you all today.
Today we're talking about state and local tax issues that are relevant to professional services firms, and our team put together some questions for us. So we're sharing what we're seeing in the market and what leaders should be thinking about next. So with that, let's jump right in. So David, state
Mhm.
sourcing rules continue to evolve, yet many firms don't realize that there's an issue until they're facing unexpected tax exposure. Why are so many professional service firms discovering that the way they've sourced revenue for so many years may no longer be correct?
I mean, first of all, we're all business leaders and we're experts in our fields. And so if I'm an attorney, I'm not necessarily thinking about state taxes. I'm thinking about my own clients and how I'm going to serve them best. But to get to the root of the problem, we really changed from a consumer goods, people buying stuff and those things getting delivered to now we're basically been a service economy for about 2 decades now. And so a lot of professional service firms are still kind of operating under the old rules. And I'll go into those old rules. So used to be if I was a attorney or another professional service provider in a state, let's say it was California, and I'm doing the work in California, that's where I'm going to source the revenue to. It's pretty simple. Even if I'm doing work for clients all over the country, that revenue used to just get sourced to the state that I was doing the work in. And now we've moved to a market-based approach where it's really where the client is that's receiving the benefit. And we'll get into the nuances and complexities of that, but that's really the simplest way to think about it. So if I'm working on a client in New York, and New York is a market-based state, which it is, then that revenue would be sourced to New York. It would not be sourced to where I'm actually doing the work in that state.
Yeah, and it's interesting because there's two different methods of sourcing cost of performance and market-based. Um, David, do most states at this point focus on the market-based sourcing, or is it still pretty divided?
Absolutely more market-based sourcing, and more states are moving towards that approach. So there's now just a handful of states that do cost of performance at this point. So for leaders who aren't tax specialists, what's changing in the way states expect firms to source revenue? Why are more states moving towards a market-based approach and not a cost basis approach?
Yeah, I mean, I think it's really based on economics. States have tight budgets, the workforce is very mobile, people are working remote. I think that's really what's forcing states to relook at this and become more aggressive. And you can have people that are performing work in Florida and they're working on clients that are based in California. So the states are really trying to figure out how to capture that revenue and be able to meet their budgetary requirements. Um,
Absolutely. If I'm if I'm a state that's outside of New York, and and California, we all know have lots of attorneys, I want some of that revenue. I don't want that revenue to stay in those two states. I want a piece of that revenue. And so that's really what's driving a lot of these decisions.
yeah. What do you think is one of the biggest misconceptions professional service firms have about state revenue sourcing?
That it's simplistic, that I can just, kind of base it on old rules and the old rules just no longer apply anymore. And even if we get more into the specifics of market based, so let's say I'm doing work for just a California client and that California client's based in California. Sourcing's pretty simple. It's going to be sourced to California because that's where the market is. But what if you're working for like a national company? What if you're working for like a Target where they've got locations all over the country? Their headquarters are in Minnesota. How do you source that? Like, do you source it to the billing address or do you get deeper and actually go, okay, what's my specific revenue source that I'm doing? What am I doing for this company? Where's the value coming in? And then attaching that value. So it could be I'm doing like a project. let's say I'm like installing an IT system that affects every target location in the country. If you were to just source that to the corporate headquarters, you might be missing a big opportunity and you could get some unwanted attention from a future state auditor. So those are kind of the nuances that we're talking about.
Yeah, and you're very, very right about that because I know as states are becoming more aggressive, they're not accepting clients' answers that, hey, I looked at where they're located. This is where the invoice is going. They are kind of digging in a little bit deeper and saying, where is that really being used and can you prove that? And some best practices that we've seen in instances is clients that do know that that's going to be exactly the situation that you just talked about, where it's going to be, invoiced to California and it's going to all of these different locations. They might be sending a questionnaire to the customer and just saying, where are these things going to be used? So I've got that contemporaneous documentation in place to be able to support that in case the jurisdiction does come knocking.
That's a really great point. States are now sharing data between each other, and obviously with AI and data analytics, they're getting a lot smarter about tracking these things. But it's really easy to open up a client or an audit with one of the clients and then go, okay, this is my new audit list. Like, let's just go through the biggest professional service firm providers and try and find some opportunities here for some more state revenue. So great point. For
Mhm.
for firms that haven't revisited their revenue sourcing methodology in years, what are some signs that it's time to take a closer look? Like they need to do a closer examination.
Yeah, I think pretty much most firms, if they're only filing in one state, that's always a big red flag. Like when we're picking up new clients that we service and we're looking at their prior tax returns and we're seeing that they file in one or two states, we do kind of dig in and start asking some of those questions of, where are people actually working? Where are your customers actually located? And trying to get a little bit under the hood and see where our risk and exposure is. I mean, it doesn't mean that you have to necessarily file in all of those jurisdictions. You still need to take an overall look at what's going on, what kind of services, and figure out where the business risk is and make some educated decisions. But at least at that point, you can um, really understand where your big risk areas are.
That's a great point. It's always a business decision, and like we all know that we live in, the real world, and that like if you do like, a very small project in a very small state, your risk is probably not that much. So it's always a cost benefit on all of these things. Great point.
For sure. For sure. Yeah, so kind of moving on to another state topic that's been top of mind lately is sales and use tax. Many professional service firms assume sales and use tax doesn't apply to them because they don't sell physical products. What's changed in the last few years that's making this a riskier assumption?
So yeah, it is true. Like if you look at the number of states that actually tax, for example, law firm services, it's like three states. It's like Hawaii and South Dakota and some other states. So pretty low low exposure there. But where it can get you into trouble is a lot of states are now taxing software as a service. So California is now taxing it. Colorado is now taxing it. That's the state that I'm located in. And so, what does that really mean? Well, like if you're a Colorado-based law firm and you're getting a software subscription, we all, whether it's research, whether it's your accounting system, anything like of that nature, that the company that's providing that service to you better be recording sales tax. And if they're not, then you have a use tax problem where you would have to self-assess use tax and pay it yourself if the supplier did not provide that. Now, it gets really simple, right? If you just have one state. But if you have like a national practice where like you have multiple locations all using these software as a service, they might not know that that's even going on. They may just think that, oh, I see your billing address. We don't have to actually withhold sales tax on this, so it's not a problem. When You could easily have firms in a national practice located in these states, and you will have a problem. And it becomes a six-figure problem in no time at all. We all know software subscriptions are very expensive, especially for law firms. And so that number can grow exponentially over a number of years.
And I think there's also some opportunity there as well, because on the flip side, if you have a law firm where they're maybe a California law firm and they're paying sales tax on everything that they have because that's where it's getting invoiced to, but 75% of the software is being used in other states, Florida, Texas, Colorado, all these other jurisdictions, there might be an opportunity to be like, hey, we're probably overpaying in certain areas and underpaying in others and trying to figure out because obviously every state's sales tax rates are different. And that also brings up the point that some states, it's not just the state tax, it's also the city and county tax. So like here in Colorado, Denver, for example, is actually a much higher sales tax rate than even the state of Colorado. So it's important to kind of look at, where are those pieces being used. And I think that it's worth taking a little bit of time and looking at that and putting some analysis down, figuring out what is actually being used where, and if there are, places that you're exposing the firm to potential liability or overpaying and you could be getting some cash back.
That's a great point. It does swing both ways, and so obviously we want to take a closer look at that. What do you think is the sales and use tax issue that surprises professional service firms once they take a closer look at their business?
I think one thing that's kind of come up recently, and it goes back to the whole SaaS question, is that software that's been bundled with services
Hmm.
and what kind of risk that can pose. Because like on the sales side, if you're selling a service and you have some sort of software bundled into it and you're not even thinking about it, and it might be something where it's a platform that you've put together for the client to access some information, some legal documents or some engineering documents or whatever that may be, and it's bundled into what you're billing the client, that software as a service could be subject to sales tax to the client. But in some super aggressive jurisdictions, that could end up pulling in the actual services themselves. So, kind of understanding the nuances of that. And there's not a lot of clear answers on this particular development just because the taxation of software as a service is brand new. And, for example, California and Colorado are both going to be effective in 2027. So definitely something to look at as these regulations are being rolled out and how this is going to be handled by each state and local jurisdiction.
That's a good point. A lot of these are just coming up on audits, and the auditor just kind of makes an assessment and it's like, sue me. Sue me
Yeah.
if you want to reverse this, you're going to have to pay a lot of money to a lot of attorneys to try and get this fixed. And so the litigation is happening, especially in really material like especially large Fortune 500 companies are actually taking this on. But that's a great point. Like you could potentially be in a situation where you think you're just providing 90% services and then just this little 10% of this software approach, and it might actually make it the 10% might taint the 90%, so to speak.
Yeah,
So
exactly.
hmm,
Yeah, so I think that's kind of in the world of sales and use tax, the biggest things that we're seeing. I think one of the other big developments in the state and local side is regarding the pass-through entity tax, also PTET. So some questions came up about that. So for the pass-through entity tax, that's become an important planning strategy for many businesses, but it's not always the right fit. What should firm leaders consider when deciding whether to make or renew those sorts of elections?
yeah, great question. And first of all, let's just talk about what the pass-through entity tax is. I know a lot of people probably listening to this have heard of it, and maybe your firm is doing it already. But essentially, old rules were, like if you made a tax payment, um, on behalf of a partner, it was really treated as a distribution. So it's really affecting your capital, but it's not really a deduction for the company. And so when we passed the Tax Act Act in 2018, they actually put a state and local tax limitation on 1040s. At the time, it was $10,000. It's since increased to $40,000, but at the time it was $10,000. So a lot of people that used to deduct those taxes on their personal returns could no longer do it. So states actually brought up a workaround, and the workaround is that you pay a pass-through entity tax at the entity level, and the company actually gets a federal deduction for that pass-through entity tax. So that federal deduction was really like the driving force that many companies desired, obviously, because why would you want just a distribution and a limitation on your personal return for 10K when you could get an allocation of that entire state tax deduction, and it's going to reduce your ordinary income from that entity. So what should leaders consider? Unfortunately, and I get on the phone with a lot of people and they're just like, man, the PTET is so confusing. I just want like a simple answer. I just want like, can you give me just a high level? And unfortunately, the PTET is not that simple. And it's because you have 36 jurisdictions that currently have it that all do it differently. And when you have partners working in multiple states, it's almost impossible to get it perfect and right. And so you really have to do some sort of analysis to determine, okay, who's, who qualifies for PTET? Does it make sense for everybody to elect in? Are there states that elect some people in and not others? It gets very complex that way. So I'll go through like some of those complexities as an example. Um, Obviously, some states like Colorado, it's either all or nothing. Every single partner has to elect in, or you're not going to elect in at all. There's some states that do allow you to have some partners elect in and not others. There's also some states that are very entity specific, meaning like it's only individuals and certain other trusts, and we're not going to allow C corps. We're not going to allow other partnerships to elect in. So the rules get very nuanced. Then when you get to the personal level, it gets even more nuanced. Sometimes the pass-through entity tax comes in your state return as a credit, but other times it actually comes in as an income reduction. And even some states like a California, for example, that credit, if it's overpaid on your California return, you can't actually apply it to the following year. There's even a state like Connecticut that has a haircut on it, meaning like if your company pays 100 grand in PTET to you, you only get to deduct 87.5% of it. So there's just so many nuances. And so it's not going to make sense for every client at all. Um, but unfortunately, and I hate saying this, you have to do the analysis. You have to do it. Otherwise, you could come up with unintended consequences.
For sure. For sure. And I think one of the things to note is that, now that the state tax deduction for 1040s has increased from that $10,000 limit that it was up to the 40,000, I think one important thing to note is that that doesn't mean everybody gets that 40,000. There is an adjusted gross income, an AGI limit to that. So a lot of professionals and professional service firms often have income that exceeds that AGI limit. So now they're being limited again. So even though it might have been like, oh, thank goodness, the 40,000 is close enough. I'm okay with that. It might still be worth looking at because you might be limited in what that is and not get that full 40 on your individual return.
So, regarding this, like, how has the conversation with clients evolved, and what questions are business owners asking today that they weren't necessarily asking when the election first became available? Because let's be honest, nobody really understood it when it initially came out. It was very confusing.
Yeah. I think the question I get most often is why would we not do this? And I think it kind of goes back to some of what you were saying, David, is just it's a business decision because it is complicated and it can increase the compliance fees. And does it really make sense? Is it a big enough deduction? Is it going to make a big enough impact to offset how much time it's going to take to administer and keep track of the estimated tax payments? because the estimated tax payments in some places have to be made in certain, certain percentages at certain dates, and it just adds a little bit more of that burden back on the firm.
Yeah, that's a good point. And I also see like many situations where let's say you have a big law firm and we you have like equity partners that are bringing in quite a chunk of change and then you have, kind of the newer partners, more of the profits interest partners who maybe are getting just a guaranteed payment. And so often what I see with the analysis, and unfortunately this does happen, but like, the people who are really in control of those firms and are making more of the money, it's going to impact them much more than the younger partners. And so oftentimes those are the partners that really drive the decision making in this. Like, and sometimes you just have to go along with it, whether it's actually giving you a tax benefit or not, as a younger partner. So
Yeah,
yeah.
I would agree. So,
Now
kind of looking forward and wrapping things up, kind of looking ahead and looking across revenue sourcing, sales use tax, and PTET, where do you see firms getting caught off guard most often, and what do you think that they should be or could be doing to stay ahead of things?
I mean, I think the sales and use tax, because of the software as a service for national firms, is going to hit a lot of firms that they don't even realize is going to be an issue. I really do
Yeah.
think that that's going to become really a burden for a lot of our clients. So definitely something that you want to keep on your radar. I think for most of my professional service firms, I've already had the PTET discussion. And so I think for most of them, we've already analyzed it and have a plan. However, if you're a potential client or a brand new client, we're going to do the analysis and we're going to, make sure that you're going to be taken care of. I think for the sourcing piece, you know, I think a lot of firms have become more sophisticated with that, but they may not understand kind of if you're dealing with national clients, you do have to ask a few more questions with that, with sourcing revenue. So
Yeah, I think that's very true. And I think that it's not only an issue from just current day to day, how does this impact the business, but also looking at things longer term. What does this mean if there is some sort of exit on the horizon for the firm, whether they wanting, PE investment to come in, whether they're looking for, exiting out of the business entirely and having to deal with M&A due diligence, because that can create a lot of hiccups and surprises that you don't want to have to deal with in that process. So, especially if you're thinking that that's something that's coming sooner than later, it's better to get ahead of that and know where you've got your risk areas and try to address them proactively so they don't end up hurting the bottom line on the back end.
that's a great point. I'd say half of, and this usually happens with new clients, where I get a new client, we kind of like have the SALT discussion, and then pretty soon, maybe 6 months later, they're like, "Hey, we want to sell in 2 years," and we're like, "Oh, okay, we should have a very serious discussion about like we should do." Um, Nexus studies, at least on the sales and use tax side, as well as income tax. And you always want to do that because um, I've seen deals fall through plenty of times because of this, because nobody wants to inherit some $1 million liability that the company didn't even realize was on their books. So great point. What do you think are
Absolutely.
the biggest differences between firms that proactively manage state tax and those that are just end up reacting to them?
I think that the firms that are proactive, they treat state taxes as something that should be addressed and is routinely reviewed. And if they're going into a new jurisdiction, understanding what those state tax obligations are from all sides, whether it's sales and use tax, whether it's income tax, what does that look like for the partners, and not just kind of going blindly, but really understanding what that looks like and not waiting for that to come up and surprise. the firm, the business, the partners, and that's an uncomfortable conversation to have where all of a sudden you're like, oh, we're under audit from this state that we didn't really think we had an issue with, and all of a sudden we've got $100,000 that we either have to pay or hire an attorney to fight. So I think it's better to understand those expectations up front and be on top of that.
Yeah. I, cost often comes in these conversations, right? Because you're going to have to pay somebody to do this work and this analysis, and who wants to incur more cost? And like even reduce the bottom line. Like most business owners don't really want to do that, and so it's our job as CPAs to really say, hey, here's the value. The value is you want to avoid this risk, this large tax bill. We're trying to help you out, keep you out of trouble. And so sometimes it's getting over that hurdle of like, you know what, it's going to cost some money, but it's going to save you money in the long term. Like, trust me. Um, so that's
Yeah.
that's definitely a big feature of this conversation.
So I think the last question for us is if a managing partner called you tomorrow and said, I only have time to do one thing this year to reduce my firm's state tax risk, what would you tell them?
Just one thing. Because I do think like from the income tax perspective, if you are kind of the one firm in a California or a Colorado, there may not be as much risk on the income tax side. You're going to fall more on that sales and use tax side. I really feel like that use tax issue is just not on people's radar. And more states are going to do it, more cities are going to do it. So I
Yeah.
would be prepared for that.
Yeah, definitely. I mean, you can do that by, jumping in and doing some sort of a nexus or revenue sourcing study and making sure you've got your ducks in a row. And definitely think that that's worth the upfront investment.
And we can do these in phases too. So like there's the full blown kind of study, but there's also like more of a high level approach. And so if you're doing the high level approach, that means you might get more like 90% there as opposed to like 99%. But
Right.
so there's various levels of service that we can provide to help companies stay out of trouble.
Yeah, definitely focusing on your biggest risk areas, knowing that, maybe you've got your top five, but of those five, maybe two or three are most aggressive and kind of focusing on that, or knowing that you're moving into a new state and wanting to address that.
Well, that's a wrap for us. We really hope that we gave you great insights into kind of the salt world as it applies to professional service companies. I'm sure it's not on everyone's radar, but we just wanted to educate and have the conversation and kind of make people think about, okay, how can this apply to my business? So thank you all very much.
Yeah, thank you for joining us for the next brief. Be sure to subscribe so you don't miss future episodes where we'll continue to explore what's shaping the future of professional services. We'll see you next time.